Something just broke in the precious metals market, and it didn't break quietly. Francis Hunt just issued a warning that should freeze the blood of anyone holding paper promises. While the mainstream media obsesses over stock market cheerleading, one of the most respected technical analysts in the world has identified a breakdown so severe, so mathematically inevitable, that when it fully materializes, silver won't just rise, it will detonate. Hunt doesn't use words like contagion and parabolic chaos casually. When he describes silver's current setup as a squeeze within a squeeze, building for 75 years, he's reading patterns that reveal the artificial suppression mechanism isn't just failing. It's collapsing in real time. This is the moment every silver investor has been waiting for. The technical breakout is confirmed. The fundamental shortage is accelerating. The industrial demand that is about to hit the market will make previous consumption cycles look like warm-up acts. Hunt isn't some YouTube personality chasing clicks. He's the strategist who called major moves before they happened. And what he is seeing in the silver market right now has him using words like contagion and parabolic chaos. This isn't speculation. This is pattern recognition applied to a market that's been artificially suppressed for decades. And that suppression mechanism is failing right now. For over 40 years, the gold to silver ratio has been weaponized against silver holders. This isn't speculation. This is documented mathematical distortion visible in the charts. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Throughout most of human history, that number lived between 8 and 15. Ancient Egypt saw ratios near 8 to 1. The Roman Empire operated on 15 to 1. Even during volatile periods, the ratio rarely exceeded 20. But something changed in the modern financial era. The ratio was pushed higher, much higher, systematically. Recently, it spiked to 126. That means it took 126 ounces of silver to buy a single ounce of gold. This wasn't natural market forces. This was systematic price distortion on an industrial scale. Hunt has been tracking this manipulation for years. He's identified the specific mechanisms, the coordinated short selling during thin trading hours, the massive paper contract dumping whenever physical demand threatened available supply, the algorithm-driven suppression that kept the ratio artificially elevated for decades. But he's also identified the moment when it started to crack. The ratio dropped below 65. That wasn't normal market correction. That was the sound of a dam beginning to fail. The sound of a suppression mechanism finally breaking under pressure it can no longer contain. Hunt's analysis reveals a massive head and shoulders pattern building for years. When these patterns break, they don't whisper. They scream with mathematical certainty. The measured target isn't subtle. The ratio is projected to collapse toward 32. But Hunt doesn't think that's where it ends. Historical analysis suggests the ratio will overcorrect. Massively. We're not just heading toward historical norms. We're heading toward historical extremes in the opposite direction. Hunt believes we're targeting single-digit ratios in this cycle. If gold trades at $3,000 and the ratio hits 9, silver explodes past $330 per ounce. Before the overshoot, before the panic buying, before the parabolic finale that's mathematically inevitable. This is where normal market logic breaks down. But Hunt isn't dealing with normal conditions. He's tracking the breakdown of a suppression mechanism in place since the 1970s. When suppression mechanisms fail after decades of artificial control, they don't fail gradually. They collapse all at once with devastating speed. While everyone debates whether silver is expensive at $80, Hunt is focused on something far more terrifying: the actual metal, the physical reality that can't be printed, manipulated, or wished into existence. 60 to 70% of global silver production comes as a byproduct. It's not mined directly. It's secondary output from copper mines, zinc operations, lead extraction. This creates a fatal vulnerability. When silver prices rise, production doesn't automatically respond. Copper mines don't suddenly double output because silver hits $100. Supply is effectively capped, fixed, unresponsive to price signals that would normally trigger increased production. This is the opposite of most commodity markets where higher prices incentivize expanded supply. In silver, higher prices hit a geological wall that can't be overcome, but demand isn't capped. Demand is exploding. Solar panel installations accelerating globally. Each panel requires silver paste for conductivity. Electric vehicle production ramping exponentially. Every EV contains significantly more silver than traditional vehicles. Smart grids, advanced electronics, medical devices, military applications. The consumption list grows every quarter. Hunt has identified something that changes the entire equation. Solid-state batteries require massive amounts of silver, not trace amounts. Industrial quantities that dwarf current consumption patterns. Hunt calculates that supplying just 20% market penetration would consume 100% of current global silver production. All of it, every ounce, currently being mined absorbed by batteries alone. Nothing left for solar panels, nothing for electronics, nothing for medical devices, nothing for investors. zero available for any other use. This isn't supply squeeze where prices rise until demand gets rationed. This is supply annihilation where entire industries get cut off from raw materials. Samsung, Toyota, and other manufacturers are building production lines right now. The demand is locked in through factory construction and supply contracts. The consumption is guaranteed. Meanwhile, above-ground inventories that were supposed to buffer shortages are proving to be accounting fictions. Hunt warns. Much of this supposed stockpile doesn't exist in usable form, at least silver that can't be recalled. Rehypothecated claims where the same metal backs multiple paper promises. ETF holdings that may not contain the physical metal investors think they own. When the squeeze intensifies, these illusions evaporate. The real silver, the physical metal you can actually touch and deliver, is far scarcer than anyone imagines. And the industrial appetite preparing to devour it is far larger than the market has priced in. Hunt has identified something most analysts miss. The current buying pressure isn't coming from retail investors. It's coming from industrial procurement managers finally waking up to the supply mathematics. These aren't speculators chasing momentum. These are corporate treasurers whose job is ensuring their companies don't run out of critical raw materials. When Samsung's battery division calculates they need X million ounces to meet production targets, that becomes non-negotiable demand. Price sensitivity becomes irrelevant when the alternative is shutting down billion-dollar facilities. Hunt describes this as the transition from financial demand to survival demand. Financial buyers can be scared away by volatility. Survival buyers pay whatever it takes because their business model depends on securing supply. And survival buyers don't stop buying when prices rise. They accelerate purchases because they realize they're running out of time. This creates the feedback loop that will drive prices parabolic. Higher prices don't reduce industrial demand. They increase urgency among procurement managers who realize the window for securing supply is closing rapidly. The companies that hesitate get cut off. The companies that panic buy early get the metal, regardless of price. We're seeing evidence of this transition in Hunt's technical analysis. The buying patterns have changed. Instead of retail-driven momentum that fades during corrections, we're seeing sustained institutional accumulation that treats every dip as a buying opportunity. The procurement managers understand something financial. Analysts don't. Being wrong about silver prices might cost them their bonus, but being wrong about silver availability costs them their career. When faced with that choice, they choose security over savings, and that choice is driving demand curves that don't follow normal economic theory. This isn't just about traditional industrial demand anymore. Hunt has identified a technological shift that transforms silver from a precious metal into a strategic resource. Solid-state batteries aren't just better than current technology. They require silver to function. The breakthrough everyone's celebrating in electric vehicles, faster charging, longer range, safer operation, all depends on silver acting as a critical component in the battery chemistry. This isn't optional. You can't substitute it. You can't engineer it out. The physics demands silver, and the scale is breathtaking. Hunt's research suggests that full deployment of this technology across just the automotive sector would require silver consumption multiples of current global production. 5 times current mining output, 10 times, possibly 20 times. Production can't scale to meet this demand, not quickly, not at any reasonable cost. It takes 10 to 15 years to bring a new silver mine online. Even if prices hit $200 tomorrow, new supply wouldn't arrive until the late 2030s. But the battery factories are being built now. The demand is arriving years before the supply can respond. This creates what Hunt calls the extinction equation. Total demand exceeding total supply by factors that can't be bridged through recycling, efficiency improvements, or wishful thinking. Price becomes the only mechanism left to ration scarcity. And when prices have to ration extreme scarcity, they don't rise politely. They explode violently until something breaks, until projects get canceled, until demand gets destroyed, until the equilibrium resets at levels that sound insane today and obvious in hindsight. The technology trap has already been sprung. The companies building these battery facilities have committed to silver-intensive chemistry. They can't change course without scrapping billions in infrastructure investments. They're locked in. And so is the demand that's about to hit the silver market like a freight train. Here's where Hunt reveals the cruel mathematics that destroy most silver investors. Even if you understand the shortage, even if you position correctly, even if you survive the volatility, most people will still lose. Hunt calls it the law of the parabola. In exponential price moves, the majority of gains occur at the very end. The final 5 to 10% of the timeline can deliver half of the total profit. But that's also when everything feels wrong, when the media calls it a bubble, when friends tell you you've been lucky, when family members urge caution. Hunt has studied how silver bull markets end. They don't conclude with neat price targets and orderly exits. They end in parabolic chaos, where prices detach from logic and reason, where silver hits levels that sound ridiculous until they're exceeded the next week. Most investors sell too early. They see silver reach $100. They feel smart taking profits. Then they watch in horror as it climbs to 200. They convince themselves it can't continue. Then it hits 300, 400, 500. The move that seemed impossible becomes inevitable, but they're no longer participants. They're spectators. This is the trap Hunt warns about. The human psychology that makes people cautious precisely when boldness is required. The instinct to sell strength instead of weakness. The comfort with small gains and discomfort with life-changing ones. The parabolic phase, when it arrives, will feel wrong every day. Prices will seem too high. Pullbacks will look like crash signals. The media will scream about bubbles and unsustainable valuations. That's not the end. That's the beginning of the final ascent. Hunt's technical analysis suggests silver won't peak until the gold to silver ratio collapses into single digits. That's the mathematical signal. Not a price level, not a round number. The ratio breakdown that reverses 40 years of artificial suppression. When that happens, silver prices won't just be high, they'll be historic. And most people won't be holding anymore. They'll have been shaken up by volatility, scared away by headlines, or satisfied with early profits that look microscopic compared to what came after. Hunt has identified something darker underlying the silver shortage. This isn't happening in a healthy financial system. The moves he's tracking, the ratio breakdown, the supply crisis, the parabolic targets, they're symptoms of something fundamental failing. By the time silver reaches the levels Hunt projects, he's not sure what the dollar will even represent. Whether it's traditional currency, digital tokens, or something else entirely, the silver explosion won't be occurring because everything's working well. It will be happening because the system that kept silver suppressed has collapsed. Above-ground inventories vanishing, byproduct mining proving insufficient, physical metal becoming genuinely scarce while paper claims multiply exponentially. The mechanisms that maintained artificial pricing for decades are failing simultaneously. This is why Hunt's price targets sound so extreme. 4-digit silver doesn't mean the economy is thriving. It means the financial structure that prevented 4-digit silver has been overwhelmed by forces it can no longer contain. The demand from solid-state batteries, the supply constraints from byproduct mining, the inventory depletion from decades of consumption exceeding production, the technical breakdown of manipulation patterns that held for 40 years. These forces are converging right now, and they're all pointing in the same direction. Hunt describes the current phase as contagion, the stage where controlled moves become uncontrolled, where orderly markets become disorderly, where suppression mechanisms stop functioning and natural price discovery takes over violently. We've already seen the early signals, the ratio breakdown below critical levels, the momentum acceleration, the supply constraints becoming visible, but Hunt insists this is barely the beginning. The real moves, the ones that reshape fortunes permanently, are still ahead. Hunt's technical work reveals something unsettling about timing. The compression pattern he's identified, the squeeze within a squeeze going back to the 1950s, has already activated. The breakout is confirmed. The momentum is building. But the violent phase hasn't started yet. Hunt describes multiple time frames all aligning simultaneously. The quarterly charts showing decades of compression finally releasing. The monthly patterns confirming the ratio breakdown. The weekly structures suggesting acceleration ahead. When multiple time frames converge like this, moves don't develop slowly. They explode. His trading platform shows positions already generating massive profits. Some up 150%, others exceeding 300%. And the trend still pointing higher. This isn't luck. Hunt explains its structure. Understanding where markets are in their cycles and positioning before the obvious becomes expensive. The opportunities keep appearing for those watching correctly. Every pullback offering re-entry points. Every moment of doubt creating better risk-reward setups. But most people miss them because they're paralyzed by price levels that seem high compared to where silver was, not where it's heading. Hunt's message is both encouraging and sobering. Encouraging because the setup is nearly perfect. Sobering because the real gains are still ahead. And selling too early will haunt investors far longer than holding through volatility ever could. The compression that's been building for 75 years is releasing. The energy behind this move isn't measured in weeks or months. It's measured in decades of accumulated pressure finally finding an outlet. And when that much energy releases, prices don't drift upward. They explode. Hunt has given silver investors a roadmap. The technical structure showing decades of compression ready to release. The supply crisis where byproduct mining meets industrial demand explosion. The ratio targets that signal mathematical certainty rather than wishful thinking. The parabolic framework that explains why most gains come at the end when everything feels wrong. Everything is laid out. Mathematical, predictable, inevitable. But roadmaps mean nothing if people lack the conviction to follow them through volatility that will test every psychological limit. Hunt warns that the hardest part isn't buying silver, it's holding it. Holding through pullbacks that feel like crashes, holding through gains that seem too good to be true, holding through media headlines screaming about bubbles and unsustainable prices. The market wants to reward patient investors, Hunt insists. The gifts are there for those willing to see them. The pullbacks that look like failures are actually opportunities. The uncertainty that dominates headlines is what creates the fear necessary to keep prices accessible for those with conviction. The moments when everyone else is selling are precisely when accumulation makes sense. But time doesn't stop for perfect conditions. Silver doesn't wait for comfortable valuations or ideal entry points. The train is already moving. The technical breakout is confirmed. The supply shortage is real and accelerating. The demand explosion is locked in through factory construction and supply contracts that can't be canceled. Hunt's analysis reveals something unsettling about the current phase. We're not in the obvious part of the move yet. We're in the setup phase that looks dangerous to those who don't understand the underlying structure. The phase where technical analysts see compression releasing while fundamental analysts see prices that seem expensive relative to historical norms. This disconnect is what creates the opportunity, the same dynamic that allows informed investors to position before the obvious becomes expensive, before the shortage becomes undeniable, before the industrial panic drives procurement managers to secure supply at any cost. Hunt's final message cuts through all the complexity with brutal simplicity. The move has started, but it's far from finished. The biggest gains come to those who understand they're not trading a commodity anymore. They're holding the only asset that can't be printed, manipulated, or manufactured, while everything else can be created through financial engineering. The ratio that kept silver suppressed for 40 years is breaking down in real time. The supply mechanism that kept prices stable is failing as byproduct mining hits geological limits. The demand structure that kept consumption manageable is exploding as solid-state battery technology scales to industrial production. These aren't market corrections that reverse when sentiment improves. These are structural shifts that happen once in a generation, the kind of shifts that create generational wealth for those positioned correctly, and generational regret for those who understood what was happening but failed to act on their knowledge. When structural shifts occur in markets, fortunes aren't built gradually through careful dollar-cost averaging. They're created suddenly through positions held when everyone else was selling, through conviction maintained when doubt dominated headlines, through understanding that the most dangerous moments in markets are often the quiet ones right before violent acceleration. The quiet phase is ending. Hunt's technical analysis shows the compression pattern activating across multiple timeframes. The acceleration zone is beginning. Market behavior is transitioning from controlled moves to contagion dynamics where small changes trigger disproportionate responses. The only question remaining is whether investors will ride the move that reshapes the precious metals landscape permanently, or watch it happen from the sidelines while explaining why they knew it was coming, but didn't maintain their positions through the volatility required to capture the gains. Hunt has issued the warning with mathematical precision. The technical evidence is documented across 75 years of chart history. The fundamental forces are aligning in ways that haven't occurred since the monetary system was restructured in the 1970s. What happens next depends on whether investors have the discipline to act on information while it's still actionable, rather than waiting for confirmation that comes only after the opportunity has become expensive. The silver shortage has already begun, quietly behind the scenes, where procurement managers are discovering that supply they assumed would be available isn't there anymore. The price explosion that follows won't ask permission from nervous investors or wait for comfortable consensus. It will simply unfold with the mathematical certainty that Hunt's pattern analysis reveals. And by the time it feels obvious to everyone watching, the generational opportunity will already be history for everyone, except those who acted when acting required courage rather than comfort.